Equity Bank posted a 52% rise in its first half pre-tax profit to 5.9 billion shillings. This driven by growth in its customer base as the group offers new distribution channels. Total income grew by 30% and loans jumped 43% to almost 98 billion shillings. The bank is expected to start operations in Rwanda and Tanzania this quarter. For more on the story, we cross now to Nairobi, where the company's CEO, James Mwangi, is standing by. Good afternoon, James, and thanks so much for joining us. Well, Equity Bank, as I said, out with a stellar set of first half numbers. This in a context where we had many market analysts, very skeptical about whether lenders will replicate last year's stellar performance in light of rising interest rates. So the first half's been pretty good to you.
Yes, it's really been pretty good, with a profit after tax growing by 57%, deposits growing by 43%, and the total balance sheet growing at 40%. We would say, under the current circumstances, it's good performance.
So let's go through some of the contributing factors here, because we've seen your customer base increase, and a lot of that being attributed to the fact that you've had these new distribution channels being introduced and pretty successful. One of them, of course, being mobile banking.
Yes, it is true. Mobile banking and agency banking are contributing significantly. At the moment, we have 20% of all our cash transactions, both withdrawals and deposits, being handled by our agents. We also have over 1 million clients now with the mobile facilities, and the ease and the convenience of the new delivery channels, together with the reduction in cost of accessing banking, has seen a significant growth in number of customers.
Well, as we've seen those customers increase, and that customer growth coming in at 28%, we've seen customer deposits rise as well, but also loans and advances to customers up 43%. James, analysts have projected that the second half of the year will see loan book growth at a far slower rate after banks increase their lending rates. Is that a risk scenario that we have to start pricing in moving forward?
I think now the bank has been able to build very strong capabilities in lending, and we'll be able to see really a balance in intermediation, where as deposits are mobilized, they are lent out to the market. So long as the market can be able to absorb more loans, we believe now we have the capability to match the two growth rates between the funding and the asset creation.
What potential rate of default are we looking at, having said that, because we've still got the Kenyan consumer constrained by rising costs of goods and services, and really put in a position where they may struggle to meet those repayment terms. So let's take a look at non-performing loans and what you're factoring in that regard.
We don't expect significant hit from non-performing loans, simply because if you look at the consumer book, which constitutes slightly over 30%, is a check of system. If it is lending to the farmers, the loans are deducted before the farmers receive their money. So that, you would say, it's secure cash flows. When you come to the businesses, most of the businesses have been able to pass over their cost to the consumers. So again, businesses have insulated themselves by being able to pass the cost to the consumer.
So where we've had somewhat of a declining trend, make itself evident in the rate of non-performing loans, is that a sustainable declining trend as you see it?
We believe we'll be able to sustain the declining trend in loan quality, reducing the non-performing rates. We are now below 2%, and we are sure we'll be able to sustain that very good performance.
Well, of course, we've seen data from the Central Bank of Kenya indicating that the average commercial bank lending rate stands currently at 14.95%, up from 14.03% in January. What's your outlook in terms of interest rates?
The bank has decided to retain interest rates where they were for those who are not able to pass over the impact of the change of interest rate. So about 75% of all our loans will not change the interest rate, and that again will cushion the bank from default rate. In the process, we're expecting this will attract more customers to the bank, and for us, the number of customers is the business driver. So we are optimistic that the lower interest rate will be offering will be more than compensated by the growth in volume of business.
Well, that's certainly what your growth in branch network is facilitating as well, where we've seen an 8% growth in expansion for the company. How are you managing costs in that context as well? Because your cost to income ratio is down from 62% to 56%.
The greatest strength of Equity Bank is leveraging and using the IT system as an enabler. Now that we have moved to agency banking and mobile banking, again we have shed off the fixed costs that go with the brick and mortar distribution channels. So that is what we are focusing on. The investment we have made in the last 3 years in staff development, capacity building, has also significantly increased the productivity of our staff. And that productivity is what is being reflected in that widening gap between the growth rate of income and the growth rate of expenses. So the bank, we would expect will continue to be very profitable as that gap widens.
Helping on the income side of things is your exposure as well to government paper. I mean, it's currently attracting an interest rate of 7%. And we've seen this increase in government security asset class and your exposure in that regard. What potential do you see that holding for the bank, and what kind of growth are you forecasting in that segment for the second half?
As you saw, we have maintained the total portfolio of government securities as it was last year. We foresaw a possible increase in the interest rates, and so we moved away from that sector. And what we are only holding is that which we have to hold for liquidity purposes. At the same time, it was rate investment, so we still have an annualized rate of return of about 9%. On government stock. So we don't expect it to affect the bank significantly. If you look at also the total balance sheet size, treasury bonds are less than 13% of the total balance sheet. So again, it's an insignificant amount.